I learned one game-changing rule about real estate at 19, and by 23 years old, my net worth was over $1 million. And no, I didn't win the lottery or inherit a fortune. This was all from applying one simple principle. Now, before you roll your eyes and think, yeah, right, another YouTuber overnight success story, let me tell you where I came from. So I grew up in a house where a trip to McDonald's was a luxury. My parents would save for weeks, counting every penny just so my brother and I could have a Happy Meal. And that was honestly like a once or twice a year treat. Now, growing up poor, I learned all the wrong lessons about money. By 18, I had maxed out credit cards, negative $187.65 in my bank account, and no clue how to fix it. I felt trapped, and I felt like I was destined to repeat my parents' struggles. But then at 19, everything changed. I stumbled upon a simple truth about real estate that the rich swear by and the poor completely miss. It's not rocket science, but it is the difference between staying broke and building wealth, and that's what this video is all about. Now, you might be asking, Daniel, why real estate? Why do the rich care about real estate? Well, number one, statistically speaking, over the long-term period of time, the average real estate investment will actually outperform other investments such as stocks, bonds, crypto, you name it, fill in the blank. In fact, even today, real estate has created more millionaires in both the United States and the world. And the simple principle I learned at 19 is one of the biggest differences in how people view it. Because poor people will think real estate investing as buying a property with the hope and speculation that its value will increase. But I learned that when rich people buy real estate, they'll actually buy it for a total of 4 different reasons and not just one. And those are, number one, cash flow, which is the income a property will generate after expenses and mortgage obligations. The next is equity growth, which is equity in principal accumulated during its holding period. The third is depreciation, which are tax benefits an owner will receive annually due to wear and tear. And last but not least, it's appreciation, which is a piece of real estate gaining value. And by the way, appreciation, which again is the increase in value, is the least important aspect rich people look for in a real estate deal, while it's the only thing that poor people will focus on when thinking about investing in real estate. In fact, here's how those differences in how people view real estate helped me hit $1 million net worth in my early 20s, and I'll show you by sharing with you a real life deal I did when I was 22 years old. Now, by the way, the remainder of this video is going to be very information driven. So if it feels like you're in a classroom, it's because you should. It means you're learning. But because it is, I definitely encourage you to get a paper and pen, take notes, and follow along with me. Now, this is the 8-unit apartment building I bought about 8 years ago, along with me signing contracts on the actual day of closing. And of course, you see my brother Sam. Now, I actually bought this building through what's called seller financing, which is when you actually have the seller finance the purchase for you as opposed to the bank. Now, the reason why the seller did that for me was because he was what's called a motivated seller in distress. Now, he was in distress because the city that the building was located in was pressuring him to do something about the massive mess that he had in the front lawn, along with all the tenants that were causing trouble. He actually had 5 out of the 8 units that were completely vacant. And because there was a lot of chaos and a lot of trouble and cops being called, the city was putting a lot of pressure on him to do something about it. Now, this guy was incredibly wealthy and he just simply didn't care about this building, and he cared more about his time. So what that actually led me to do was to actually buy the building for the same price that he bought it in the 80s. And this was back in 2017. So that being said, now let's actually get into the numbers and also look at this deal through the scope of how the rich view real estate. Now, the terms of the seller financing deal was that the price was $250,000. And because the owner wanted to close very, very quickly, because he actually had court the next week for this exact property, I proposed a 0% down purchase, which means I had no money that I needed to bring to the closing table, because my argument to the seller was, hey, if we want to close on Friday, because this was on a Tuesday, I don't have the time for either myself or to bring on an investor to bring whatever money you want up front. So if we want to do this deal as soon as possible so that you don't have to deal with the city anymore, we actually have to do a no money down closing in 3 days. So we did 0% down on top of giving him a 4% amortized interest over the course of 25 years. Now, if you put those numbers on a mortgage calculator, you'll get for the monthly payment $1,319.59, which annually it's $15,835.08. So that was our annual mortgage payment that we had to make to the seller every single year. Now, as I mentioned earlier, there was a lot wrong with this property, a lot of work that needed to be done. So I ended up bringing on an investor and raising capital, which is just a fancy way of just saying you had somebody invest the money on your behalf to actually finance the rehabbing and all the work that needed to be done for this 8-unit apartment building. And that number was about $150,000 that we needed for the rehab of this building, because there's a lot of things wrong, a lot of things broken that needed to be fixed, a lot of repairs, maintenance that needed to be done in order for us to be able to get all the units to the point where we can get tenants in them. So that process took about 18 months for us to, again, repair everything, right? Get maintenance up to date. Now, the good news though is that every single one of these units were 2-bedroom, 1 bath. And at that time, the market told us, right, all the other units in that area, which were same size, same condition, same neighborhood, were renting out for $950 a month. So during the stabilization process, which is pretty much a fancy way of saying, hey, the time that we need to get all the units back on track, to start marketing them and get tenants in them, well, afterwards, our numbers looked really, really good because we had 8 units times $950 a month, which if we do that math, gives us $7,600 per month. Now, if we multiply that by 12 and make it an annual number, that's what gives us $91,200 per year. Now, did we collect all $91,200? No, because there's times where we obviously had a vacant unit or we had a tenant not able to pay the full rent. So between vacancy and non-collection, along with other operational expenses, which are taxes, maintenance, utilities, insurance, repairs, right? All the things and expenses that come with being an owner of real estate. Between all those things, it contributed to about half of that $91,200. So if we go ahead and divide that by 2, we had a net income, which by the way is one of the most common terminologies in the world of real estate investing, which is the NOI, the net operating income. We ended up with $45,600, right? Now, the good news though is because our annual mortgage was so low, we were able to cash flow on this property, if we do the math, just below $30,000. Now, for those of you guys that are a little bit more detail oriented, we take $45,600 minus $15,835.08, which is our annual mortgage that we give to our seller. That gives us a net income of $29,764.92. But we're just gonna say $30,000 for the sake of the video, just simplicity. Now, all that being said, if we again look at this deal from the lens of how the rich view real estate versus how the poor view real estate, the rich will say, great, $30,000, that's just one of the 4 benefits that we're gonna get from the deal. And now if we look at the second benefit, it's the equity and also the principal that we're paying down every single year, which the equity that actually we achieved, because by the end of our stabilization process, when all the units were rented out, it actually got valued at $670,000. So if we're doing the math here, benefit number 1 is $30,000 a year coming in cash flow, which is, hey, that's phenomenal. Even if we just did 4 of these deals, we're collecting $120,000 a year in monthly passive income. I mean, you're bringing in 6 figures. You're earning 6 figures without having to set an alarm and trading your time for money. Again, the reason why it's the number 1 benefit for a lot of rich people when they think of real estate deals. Now, benefit number 2 is the new valuation at $670,000. Now, because we bought this thing at $250,000, we now had $520,000 worth of equity after just 18 months. And we also have to remember that when we look at a mortgage calculator, this $15,835.08 that we're paying, well, a good chunk of that is principal, right? Some of it's interest, but a good chunk of it is principal. In fact, in year one, $5,943.28 went towards principal in just the first year. So benefit number two is that $520,000 worth of equity and also the $5,943.28 that we accumulated in principal in just year one. Now, what the rich do that the poor don't know is then they take this $520,000 in equity and they do what's called a cash out refi, which is when you actually renegotiate the financing terms, and in the process, you take out cash in exchange for the equity that's already in the property. So because we have $520,000 in equity, what a bank might let us do is allow us to cash out $400,000 in cash in exchange for that equity so that we can either keep or, in my suggestion, go off and do other deals. Now, the best part about that is because it's a loan and it's not a liquidation or a sale event, that money, that $400,000 hypothetically, is all tax-free. And that's how the rich are able to maintain as much of their wealth while still keeping the property, while also collecting, remember, the $30,000 every single year in cash flow. Now that said, the third benefit, which is arguably one of the most important benefits that the rich look for in leveraging real estate investing, is depreciation. Now, what depreciation is the annual tax benefits that the IRS allows us to take for just normal wear and tear in owning a property. And the way that you actually calculate that is you take the assessed value of the building and you divide that by 27.5, because that's how long the IRS allows us to depreciate out a property. So the way that we have to calculate this is we have to take the assessed value of the building, which at that time for us was around $550,000 out of the $670,000 valuation. And we divided that by 27.5 years, which, if you're following along with me, 550 divided by 27.5 years, that gives us about $20,000 annually in depreciation, which means that you're able to reduce the amount of taxes that you have to pay with only certain types of income, which for the rich, most of their income is not a standard W-2. A lot of it might be dividend income, it might be investing income, it might be passive income, but regardless, they're able to leverage this $20,000 in depreciation that they don't have to pay. So on top of the $30,000 they're receiving in cash flow, with the $500,000 in equity, they're also receiving every single year $20,000, which is why for the rich, it's the third and one of the most important benefits of owning a piece of real estate. Now, the fourth one, which we previously kind of already touched on. Now, this is when you increase the value of a building, but the rich do it differently than how the poor do it. The poor will utilize time. So they'll say, oh, I'm gonna buy a piece of real estate and I'm gonna wait for time to make it go higher. Now, the terminology that describes buying a property and waiting for it to go up through time is what's called passive appreciation. Now, in my definition, it's not truly appreciation, because is the building increasing in value through time, or is it increasing because it's just inflated? As in, you're just waiting for inflation to increase the value versus something differently. Now, the way the rich utilize appreciation and how they control the value, not just having it be at the mercy of the market or the economy, is what we call forced appreciation. Now, forced appreciation is when you increase the value of a real estate property, not through just time or because of what's happening in the market or even what's happening around the local area, but you're increasing it by increasing its output, aka its net income. And that's how 99% of rich people leverage appreciation and increase the value of the property. They control it by controlling how well it performs. Now, the difference in how the rich and poor look at real estate, explaining that concept practically, is that the poor will say, well, what's an area that's about to boom and grow? Because that's how they think about buying real estate. Whereas the rich will actually look at market studies on how rents are performing in different areas. They don't necessarily care what's happening in the area. They're just trying to look for the properties that are not performing as well in regards to rent. So they'll try to find properties where rents haven't increased in 10, 15, 20 years because they know they can buy it, catch it up to market rent, and have so much more equity and increase in value because the income is higher. So not only do the rich know how to control appreciation, but all the while doing that, they're receiving, in this deal, at least I received, $20,000 a year in tax benefits, along with over $500,000 in equity that we actually, as a partnership, decided to keep in there because it doesn't increase the monthly mortgage payment that we'd have to pay. And we also enjoyed a $30,000 a year in cash flow. Now that, my friends, is how the rich view real estate compared to the poor. And it's no wonder that it is the #1 way that the rich will leverage to build their generational long-term wealth, not just what they do in the short term. Now, to cap out that story, I actually ended up selling this building just 4 years later for a lot of money. It was an offer that I couldn't refuse, and I ended up just letting it go and releasing it because it allowed me to take the proceeds from that deal and actually scale multiple different companies and other real estate projects because of it. Now, if you guys want to learn more about real estate, I actually have a free real estate investing course that I'll actually plug in the description for you guys. Again, it's all free, no payment, no nothing. You just have to go and check it out and learn. So thanks guys again for watching this video, and I'll see you guys in the next one.